In this video, we will continue with our discussion of the risk-free rate, and what I'm going to state here is what do I believe is the normalized risk-free rate. And I'm going to do a simple approach. There's several ways to think about it. The normalized risk-free rate should be the real interest rate, that is the historical rate of interest that we got when you take inflation out, plus what you think expected inflation will be. From my standpoint, I believe you can tie the 10-year Treasury to the U.S. economy, and we've already talked about that when we came up with the expected return for stocks. We tied that to the U.S. economy as well. But I'm going to make this bold statement that the normalized risk-free rate should be nominal GDP less 0.5 to 1.5%. I'm going to actually use the higher number, given that interest rates are low and they've been low for quite some time. I'm going to err on the higher end of this and subtract 1.5%. So I think nominal GDP, I expect it to be 5% as we calculated above. So you take 5% minus 0.015 and you get a risk-free rate of 3.5%. Now my support for that is I provided another chart. If you go back in to the miscellaneous class materials, I provided a chart that could give you some evidence for the normal 10-year Treasury. It's a chart very close to the components of GDP growth. It's a chart called Tenure to Nominal GDP. If you look at this chart, you'll see what the 10-year Treasury has actually been historically versus nominal GDP. And here it is. So you see there's nominal GDP. You can see it's substantially above the 10-year Treasury until the early 80s. And in the early 80s, it's below. And in the last several years, it's been bouncing above and below. Here you can see, I think, the artificially low 10-year Treasury because it's well below GDP growth. But it does bounce around. For a long period in the 50s and 60s, when interest rates and inflation were more normal, the GDP growth is about 1 and 1.5% above the 10-year Treasury. Since the 70s with high inflation and then now with the very low 10-year Treasury, you're seeing that they're more in line with each other. But I'm going to err on the side of a lower 10-year Treasury. I'm not going to go all the way to the current 10-year Treasury, which is below 2%, but I'm at least going to normalize it at least a more normal level of 3.5%. So that means that my market risk premium is going to equal my expected return on stocks minus my risk-free rate, which is going to equal 0.07, the 7% we got above, minus 0.035, or 0.035 is my market risk premium. So a 3.5% market risk premium and a 3.5% risk-free rate. That may seem confusing. They're the same number. That's just pure coincidence. You notice that in this entire discussion about the risk-free rate and market risk premium, I did not discuss Walmart at all. It has nothing to do with Walmart. I do take off many points if you bring your company in. Remember, you do not use your company's current dividend yield. You use the current dividend yield of the stock market. You don't talk about your company's expected earnings growth. You talk about earnings growth of all the companies in the S&P 500. So this entire discussion is completely independent of your company. But next, what we're going to do is come up with the beta for Walmart. This, you will talk about Walmart. If you remember in class, we said there are several steps here. The first step is to talk about revenue sensitivity. The next step is to talk about operating leverage, then financial leverage, and then the historical beta. I'm not going to do the historical beta in this situation because you have a separate video that shows you how to do that. But when we come to revenue sensitivity, I'm going to say this is a low beta, below 1 for Walmart, as it is It's a discount store. Sells low-priced goods. It will hold up well in a recession. It is a defensive stock. And in fact, they did hold up very well in the 2008 recession. So this is a non-cyclical, a defensive stock that should have a beta below 1. Now, operating leverage and financial leverage, we're talking about fixed cost. And so I'm going to say Walmart has relatively low fixed cost. Why? Because it has an hourly workforce, and it pretty much keeps a pretty steady gross and net margin. The way I can prove this last part is, remember the other spreadsheet that I gave you in the class was the Excel spreadsheet that allows you to calculate for your company what their volatility of gross and net margin is. Let's see if I can find that spreadsheet and see the name of it. It's called Bloomberg Data for Beta Calc. So I'll bring that spreadsheet up. And it's extremely important in this spreadsheet when it comes up that you don't just type the ticker of your company in. Instead, what you need to do, and I'll expand it out, is go to C1, hit the equal sign, and then go to the second page. And in the second page, come down and look for your stock. I'm going to go all the way down to the bottom because Walmart starts with a W. It is alphabetical by ticker. I'll just find Walmart, hit enter. It brings up my Walmart numbers. And then what we can see is for gross margin standard deviation and net margin standard deviation, you can see their gross margin standard deviation, they rank in the top 13% for having very low gross margin standard deviation. Their standard deviation to gross margin is only 1.26%. The typical stock in the S&P is 2.88%. And their net margin is even more stable. They're in the top 1%, a 0.37 net margin versus 3.26. So you could actually bring this entire thing in to your paper and just talk about it, talk about the numbers and how that provides evidence that your firm has low operating leverage because it's so stable in its gross and net margin. Financial leverage is how much debt it has, so this same spreadsheet will help you with that. And we can see, well, Walmart, their debt is actually slightly above average. So when you look at their debt to equity, this is not the standard deviation debt to equity, but the actual debt to equity. Their debt to equity is 71% versus 62% for the typical stocks. So they're actually a little above average in their debt. So I'll bring that in. Paste it as a file so you can see you can use this spreadsheet and just bring it right into your paper. Good to do it as a bitmap. I might shrink them down a little bit just so they don't take up so much room. Oops, I didn't mean to do that. And so what we can say is for operating leverage, we can say this implies beta below 1. And for financial leverage, we can say this implies beta around 1. But revenue sensitivity is below 1, definitely a defensive stock. Operating leverage is well below 1, definitely a low operating leverage company. And then financial leverage, because their debt is a little bit high, and the median S&P 500 company, that implies the beta a little bit higher. When we look at the historical beta, I won't do that here, but when you look at it, it implies a beta well below 1 recently, but per the above, I'm going to use the longer term trend of a beta. I'm going to go with 0.8. I think 0.8 makes sense for Walmart, but you need to come up with your own numbers, look at the historical, make sure you justify financial leverage, operating leverage. There's a lot of discussion you could add on operating leverage. We have it in the notes. How much property, plant, and equipment do they have? Are they hourly workers? They have labor workforce. They have a lot of research and development. And those things that are fixed costs, like research and development, a large marketing budget, a lot of property, plant, and equipment, which creates depreciation, which is a fixed cost. Those are the things that will contribute to a firm having higher operating leverage, and it should flow through to the volatility of their gross margin and their net margin. And so when we do all this, we come up with a KE for Walmart. It's going to equal our risk-free rate, 3.5%, plus our beta, 0.8, times our market risk premium at 3.5%. And when we do all of that math, I'll go into Excel and calculate it. So 0.035 plus 0.8 times 0.035, and I get a discount rate of 6.3%. And that's the last thing you do on the paper related to discount rates. Although you can continue your paper in the same paper, just the valuation would be the next section. But we've got our discount rate for Walmart at 6.3%. So in the next video, we'll start working on the valuation.